Hey everyone, and welcome back. I've got a slightly different video today. I'm going to attempt to answer the question, who is buying all these expensive cars out there? The past few years has been pretty crazy in terms of the car market, and it just doesn't seem like it's going to quit, even though everyone expects it to lose steam. So, um, there's a lot of like nonsense out there on forums and social media about who actually buys expensive cars and how they actually pay for them. I've got a bunch of brands up here. I don't know how Genesis and Infinity made it into this little graphic, but um, for the purposes of this little slideshow, I'm going to assume that expensive cars means anything above 100 grand. Obviously, there's no real top to the expensive car market. I mean, people pay millions and millions of dollars for cars, but most of the expensive cars that you see out today are between, let's say, 100 and I don't know, about $300,000. And I live in a big city. I live in LA, and there are a ton of these cars driving around, and there are all sorts of people with all sorts of financial financing behind these cars. So I'm just gonna try to sort of recap what I see out there based on what I know and based on my friends who work in finance and who are also into cars. Um, so let's go. So the standard answers that you find on the internet are not invalid, right? Like this list of types of people, groups of people they're definitely out there and they definitely buy cars with their money. So, just running through the list real quick, the top three are basically the same: trust funds, rich parents, and inheritances. There's, quite a few people out there who are just born rich or ended up getting a bunch of money from their family in one way or another. And, they're not that common, but they're common enough to be considered when you're talking about people who buy expensive cars. I don't really need to go into detail here. I mean, they're pretty self-explanatory. There's rich kids out there, rich people, rich families. They just buy cars, amongst other things. The next couple, gambling and lottery winnings. This is also pretty rare, but there are people out there. There are professional gamblers or just people who got lucky, who are just out there cruising around in really expensive cars. This is obviously not something you can necessarily replicate. In fact, this entire first slide is all stuff that you either can't or don't really want to replicate, right? Um, Fraud and crime. People steal money. There's a lot of that going on these days, and of course there are just dumbasses who buy cars they can't afford. On the internet, people think this is more common than it really is. The truth of the matter is, in my opinion, people who can't afford really really nice cars or expensive cars over 100,000, they just don't have access to the money to to get one. So they either just don't have the cash or they don't have the credit to buy these cars. So it's not that often that you see a true dumbass that's broke, cruising around in a $200,000 car. It's just not really possible. There are plenty of these people who drive around in, let's say, aspirational cars, like entry-level luxury cars. But that's not really that interesting, and nobody, everyone kind of knows what's going on, and nobody really looks twice at cars or people like that. Okay, next slide. First group of people, and this is probably pretty obvious to the older folks out there, like anyone over, I don't know, 30 or 35. Like this stuff is pretty self-explanatory, but for those of you who are younger or who have not been working for very long or who have just kind of not been paying attention, um, the next group of folks that drive around in really nice cars are very high earning professionals. These are generally people with careers that require some kind of college or graduate education. Not always, there are obviously plenty of exceptions, especially in my industry, which is technology. Lots and lots of people have no college degree and make lots of money. So, you've got your standard doctors, lawyers, accountants. Generally, by the time they hit age 35 or 40, they are usually either very close or actually, either very close or actually partners in the firms that they work in, which means they're responsible for generating business, and their income is basically tied to the results of their work or how hard they work. Either that, or they just started their own firm at some point, and after a few years of probably some startup struggles, they have a book of clientele and their incomes are pretty high. Potentially in the mid six figures is not uncommon. Easily 3, 4, maybe 5, or even $600,000 a year. These are very achievable incomes for just a hardworking, dedicated doctor, lawyer, accountant type of person. Number 2 is finance and bankers and people who do high-end sales in hot industries like technology or finance. The thing with these folks is they have performance-based compensation, so they have more direct control over their income, right? Like whether it's just working harder or working a lot smarter, they actually have a feedback loop on the type of work they do, how much they do, and the amount of money they make. So, these folks can scale up into the millions of dollars a year in income, by the time they're mid-career, let's say 35, 40 years old, and it's not uncommon for them to be driving around in a very, very nice car. Number 3 is certain tech workers, like very talented or very lucky software folks or, project managers, people with very specialized skills in the tech industry. These folks they don't have as much social prestige as, let's say, doctor, lawyer, accountant, finance guys, but they can sort of fly under the radar and make quite a bit of money, especially if they work for one of the large companies that everyone is familiar with, and most of their compensation is equity or options or something of that nature. Generally, the salaries are capped near one of the 3 or 4 upper tax brackets, just because the payroll taxes and actual income taxes that the companies and the people pay starts getting kind of ridiculous, and companies try to shy away from high salaries in this line of work because it's just not very effective, it's not very efficient at compensation. So if you can give someone stock or options instead of a salary, that basically just defers all the taxes until later, at which time they either cash out or do something else with the money to trigger some kind of tax event. Then, of course, you just have your run-of-the-mill executives, like MBA types, that work for large public or private companies. And, that's basically just a mishmash of salaries, bonus, and stock comp. So, as a group, these people are probably, let's call it the top 5 to 10% of income earners. And in large cities, these people are everywhere. All these big, huge corporations are staffed with people who make a lot of money, and they don't necessarily, you may not necessarily know it when you meet them, but a lot of them like cars, and a lot of them purchase very expensive cars. Next type of person is the entrepreneur. This is where you kind of get a much more diverse type of job. You've got small business owners of all types, whether it's technology or manufacturing or construction or services like photographers or something of that nature. Even small restaurant owners can do quite well if they find some kind of niche and they figure out how to market it successfully. The key with these types of people is They may have like modest incomes, let's say less than mid six figures, maybe even one or $200,000 a year in net income, but it's very, very steady. Like as long as they show up to work in their business, they will make the money, and they may have very good years where they double or even triple their income, and that is very, very conducive to, like getting a nice car and the kind of finances that are required for getting loans and leasing cars. A little bit more about that in the next few slides, but yeah, that's the first list on the list here. Number two is startup founders with exits, liquidity events, or large fundraising. So people who do startups, whether it's technology or any other kind of startups, those that sell their business generally do it only when they either are forced to or when the deal is too good to turn down, right? And you don't always have to sell your business outright. You can also sell, when you start a company, you own all of it, right? The co-founders own all of it, but what you can do is actually sell part of your shares to potential investors and keep some of that money yourself. That's called a liquidity event, and that happens more often than you would think, especially with a team or a founder that has been working for years and is kind of just paying himself a nominal salary. Once they raise money, usually what happens, not usually, but sometimes what happens is they will actually give up a portion of their own equity in order to make some money themselves. Generally, at that point, it's a long-term capital gain, so the taxes are minimized on that. But yeah, they can usually divert some of that fundraising into some personal income by giving up a share of the business that they are running. Then, of course, there is the social media winners and all that stuff that you see online that you're probably pretty familiar with if you're a younger person on the internet. You got influencers, content producers, people who do like writing copy for web content and sell courses, etc. I mean, those people can make quite a bit of money. You're basically dealing with zero marginal cost of product, which means the thing that you're selling basically doesn't cost you anything to copy and sell. So it's a large upfront investment in either time or money, but once the sales flywheel starts going, you can really start making quite a bit of cash without any incremental effort on the marginal product. Which is why software and media and influencers and social media is so popular these days, because it's very, very, it's easy to get started, and you can really hit it big if you go, if you figure out some way to market yourself appropriately. Okay, next is smart investors. This group of people is kind of a super group, as in this could potentially apply to anyone, right? Like anyone with a regular job who is extremely smart or extremely lucky can end up in this category of people. If you worked at a pre-IPO company that happened to make it big, or if you got hired at a post-IPO company that has good compensation and you just grind it out for 1 or 2 decades, you're going to end up with a lot of stock-based compensation, and that is untaxed until you actually liquidate and spend it. So, this could potentially be hundreds of thousands or even millions of dollars if you are lucky enough to work for the right company. Everyone knows about crypto. Some people just strike it big. That's definitely a thing. Other people lose it all, but some people definitely strike it big. One other thing that most people don't think about is there are also people who have invested very, very smartly, very intelligently into bonds. And something that most folks don't know about bonds and government securities like treasuries is a lot of them are tax advantaged, which means you don't necessarily have to pay federal, state, or local, or some combination of that, income taxes on the money that is generated by those bonds. So this obviously depends on the particular security and the particular jurisdiction that you're in, but that's one way that a lot of people generate a ton of income, especially when they're older and they just have money to park that they want to park with minimal amount of risk. Folks with real estate appreciation or houses that they've refinanced at low interest rates, some people, especially in a place like California where I'm at, they bought a house in 1990 something and sold it, 2 or 3 years ago, and have made a absolute killing on the difference in the price that they paid and what they sold for. So, it's not uncommon to see people cashing out, selling a house that they bought, and then pocketing about $1 million or more of cash, and then simply moving to another state and bidding up the prices there, but then just keeping the difference. And then, of course, you can, those people have been in the news recently and kind of catch a lot of hate because they're pushing up real estate prices in all sorts of areas. But of course, there's two sides of that coin. There's people who are also very happy that the Californians are coming in and driving up the prices of the homes that they bought. So, they're kind of continuing the cycle of real estate appreciation in a different state, bringing in outside money. There's also just regular old debt, right? Like HELOCs. You can refinance your home and pay whatever interest rate the mortgages are going at, and either take out a big chunk of cash and pay it off like a mortgage, or just have a revolving line of credit that you pay down over time. Of course, there's old people with big retirement accounts. I mean, the stock market has, who knows, quadrupled over the last 20 years. So it's definitely a source of wealth that shouldn't be ignored. But point number 5 is important. A lot of this stuff is just time and luck, right? These folks that have made good investments or have chosen the right companies to work for, or have giant stock portfolios or bond portfolios. A lot of this is just stuff that happens as you get older. I know as a young person, that's kind of hard to wrap your mind around, but a lot can happen in 20 years of work that you just have no way of foreseeing. Like, you might just get lucky and, end up with millions of dollars by the time you're 40 or 50, which is, way before retirement and definitely young enough to enjoy a nice car. Okay, then the last category here is just single guys with no obligations and crazy gearheads who are just really, really into cars. Like crazy car guys basically just don't care how much a car costs. If they have a job and they're single and they have no family, they will spend an enormous chunk of their income, potentially a third to a half of their expendable income, on the car that they want. A lot of times these guys have been wanting to buy a specific car or a specific type of car for basically their entire lives. Like by the time they, way before they were driving, like maybe when they were 12 or 13, they've just been into cars. And, these guys are generally pretty smart. They're typical young dudes who probably started working early. They're mechanically minded. They're technically minded. So they're capable of making income, and they just want to spend money on cars. This is, you can't overlook that. A lot of these dudes are out there who just really don't care how much something costs. As long as they can afford it, they will buy it. Divorce guys or midlife crisis guys who really don't care anymore. I mean, I don't know how common this is, but it's definitely a thing. I mean, the stereotype exists for a reason, right? Like, divorced guys who are no longer, responsible for taking care of their family unless they have some kind of alimony payment or child support. They're just at a new phase in life, and they will just buy expensive cars because, maybe part of the reason they got divorced was because they work too much. They make too much money, and it just doesn't matter to them. Either way, these sort of single guys, they usually save for a few years and have the money, since they don't have anything else to pay for. And they generally have high-paying jobs, like good jobs like either good blue collar jobs or technology jobs or finance jobs. I mean, basically anyone under the age of 30 or over the age of 40, like that pre-marriage and post-marriage time frame is potentially in this category. So the next section is, how do they actually finance these purchases? There's way more ways of financing a car than you might think when you're younger and you don't really know how the world of finance works. A lot of people think that the only two ways of buying a car are cash and just going to the dealership and getting a loan from the bank. That is to buy the car. So, those two definitely are the two main ways that folks end up financing cars, but there are a lot of different ways of getting money to purchase a vehicle. I'll just run through them real quick. Cash purchase. This is obviously very straightforward. You have the money, you just buy the car. So this is actually very rare, despite what anyone says on the internet. People on the internet claim that, oh, I only buy my Ferraris in cash or whatever. A lot of times this is just bullshit. It's just a flex. They just say it because it sounds cool. The reason it's rare is anyone with enough money to buy a sports car or let's say $100 to $200,000 car outright with cash is going to think that they can make more money with that cash in the meantime. That's just the mindset of most people with that kind of money. They think they can make more in the stock market. They think they can make more in their own business, or they think they can make more in some other, maybe in crypto or whatever, right? Like the thought of just spending, let's say $200,000 in one day is kind of not very smart, even if you can afford it. Because generally what you can do is put that money to work somewhere else. And, folks who have that kind of money and are into cars are generally pretty ambitious, and they can usually think of something better to do with the money. Even if it's just for extra security, right? Like if you have $1 million in cash, do you really want to spend a third of it or, a quarter of it plus tax in one day and have that giant hole in your balance sheet? Or would you rather just finance the car somehow and keep that money either in cash or treasuries, or try to make more money in the stock market or whatever, or in your business or whatever you do with it? Most people, the vast majority of people with that kind of cash will try to find something else to do with the money, because otherwise you're just throwing it away immediately instead of giving it a chance to make you more. Number 2 is bank loan finance. So this is the thing that pretty much everyone is familiar with. You go to the dealership or you go to a Capital One or whatever, and you say, okay, here's my credit. This is the car I want to buy, or this is the price point that I want to borrow. What can I do? What can you do for me? What's the interest rate? What's the term? This is all very standard. When interest rates are low, this is very popular. When interest rates are high, it's less popular, but some people just have to borrow the money, and that's where it can become predatory. The banks will just totally ream you on like a 20% interest loan over, multiple years, like 5, 6, 7 crazy amounts of time. So you end up paying 2, 3, times the value of the car, which is just insane. But, people do that. The third option here is just a straight lease. Usually people who lease cars have some kind of business, an LLC or even a sole proprietor business or an actual company, corporation that they run. And what they do is they build up a history with the business, so they have a trade history, and then they just buy the car, lease the car under the business, and they just straight up expense it to the business. So the reason this is tax deductible is it just becomes an expense, like it just becomes like a piece of equipment that you buy. And people like to sort of stretch the rules here a little bit. They'll say it's for marketing, or they'll say it's for going to client sites. This is where you see a lot of the really expensive trucks, like the blue collar guys who just buy six-figure trucks because it's better than paying taxes on it, I guess. Or you have like the startup guys who, claim that they're marketing their business with their Ferrari or Lamborghini or whatever. That is that definitely falls under number three. There are people who just lease the car and then claim it as a business expense and don't try to justify it in any way. That is something that people do, and that's not uncommon. I don't know how the IRS will look at that, but generally the rule of thumb is that if you actually spent the money, they're not going to hit you that hard. They will probably let it slide. So this is a very popular way of doing it. Like the IRS only gets upset if you try to fake any income or fake any expenses. Like if you say you made less than you did, or if you say that you spent more than you did, that's when they really have a problem. But if you actually spent the money like it's gone, especially if you just spend it out of the business account, they're generally not going to look at that as some kind of, lie or fraud. What's popular, number four is also popular too. Some people do a lease and then buy out the car, either at the end of the lease or at some point during the lease. This is also partially tax deductible. All of the lease payments will be tax deductible until you buy the actual vehicle. If you buy it under the business, you'll have to depreciate it over a certain amount of years, and that may be better or worse than just leasing it. But if you buy it if you buy it out of the lease under your personal name, that's generally not tax deductible. You just have to pay it with after-tax money. Number five is something that most people aren't aware exists. So for people with substantial assets, like let's say you have over $1 million or multiple millions of dollars in a brokerage portfolio, you can actually borrow money straight from the brokerage. It's called a margin loan. And what they do is there's an interest rate associated with it, which is probably, like the risk-free rate plus 100 or 200 basis points. But what you can do is actually just buy a car using money that you borrowed from your broker and then pay back that loan however you see fit. So if you want to make payments on it, you can do that. If you want to slowly sell your portfolio assets to pay the loan down, you can do that. If you want to refinance that loan with a bigger loan from somewhere else, you can also do that. So this type of thing is basically for people with very large portfolios that need flexibility in how they finance things, and they don't want to open up a new relationship with another financial entity. So they don't have to apply for a new loan. They don't have to do any of that stuff when they want to buy the car. Or people use this for houses and boats and all sorts of stuff. But this is a very, very popular way for rich people to buy toys. Basically, they essentially just wire money from a brokerage account to whoever's selling the asset that they want or the toy that they want, and they'll figure out a way to pay for it later, which is pretty popular among rich people. Number six, I touched upon this a little bit earlier, mortgage refinance or HELOC. If you're sitting on a house that's gone up in value by hundreds of thousands of dollars or potentially even millions of dollars because you bought the house back in the 80s or 90s, you can just tap your mortgage or your HELOC for $200,000 without anyone even looking at you twice. Especially if you can prove that you still have a high income and you have millions or $1 million or $2 million of equity in your house, they will instantly loan you $200K without a problem. And number seven is you can also just continuously trade up your car, right? Like you can have a car, keep it for a couple of years, pay it down, and then hopefully you're not upside down on it. But what you can do is just trade that equity up into a more expensive car, just like a house. This is actually pretty common. Most people do this once or twice in their life when they upgrade their car, but some people make a game out of this and can just lever up step by step, you know, from a pretty modest performance car into something really, really expensive. And, you know, if you do it intelligently and you actually have the income to back it up, this is actually a pretty good way of sort of paying towards a car that um, you couldn't necessarily afford 3 or 4 years ago, but you can now because you've built up some equity in some other cars that you've paid down over the years. This is obviously very dangerous, and this is how people are getting upside down these days in overpriced cars that have dealer markups and all that stuff because they just weren't smart about it. They overpaid, and then once they're upside down, you can only do this little trick, you know, maybe once before you just become so upside down on the loan that the collateral, i.e., the car that you're driving, can't cover the loan that you're trying to get. So once you're in that situation, you really have no choice but to either pay off the car slowly, sell it and eat the loss and pay that off, or just declare bankruptcy and have your car repoed. Unfortunately, that's just how it works. Okay, so what about insurance? If you're younger and you only have one car, you're going to be wondering who the hell is able to afford insurance on a Ferrari or a Porsche or an Aston. Well, fortunately or unfortunately for you, insurance is much, much cheaper when you're older and you have a high-end car. It's surprisingly cheap, actually. It's actually, for an older person with a good driving record and a good income and, you know, all the right statistics, it's actually cheaper to insure a high-end car versus something like a Toyota Tacoma or a Chevy Suburban, because those common cars that everyone drives are constantly stolen, constantly getting into wrecks. People generally don't take care of them, so they're more likely to get into accidents because of bald tires or poor maintenance or whatever, right? So all this stuff is baked into the insurance company models. And they know that generally the people who drive higher end cars and who are a little bit older and have a good driving record are nothing bad will happen to them except for actual like disasters, like, you know, somebody will like target, you know, one car out of 1,000 for some kind of high-end theft, but generally nothing happens to those people. They just drive their cars, and they're very conservative drivers, and they just kind of putt around in their cars and nothing happens. There are also specialty insurers like Hagerty and Chubb for stated value and aftermarket value dollar amounts on these cars. So, you know, if you go to Progressive or, I don't know, State Farm for an insurance policy on your Ferrari, they're probably not going to want to service you because that's not what they specialize in. They don't want to take the loss if something were to happen, and 100 other reasons why they're going to give you a very, very high rate. But if you go to a company like Hagerty or Chubb or something like this, they actually are car people. They have people on staff who know about cars, know about the car market, know the audience and know the market for insurance and aftermarket value on stuff that you would put on these cars. So they can actually craft a better policy for you that fits your profile a lot better than the major insurance companies can. Generally, this is going to come with a multi-car discount. You're going to put something really, really low on these cars, like under 3,000 miles a year. And that just helps with the overall risk profile of the car. So again, it all depends on your age, your credit, your location, your driving record. All this stuff factors in, right? But generally speaking, you can't apply the logic of like insuring your daily driver $30,000 truck to a high-end sports car that's like a second or third car for a 50-year-old man living in, I don't know, you know, a wealthy part of the state who has a perfect driving record. Like, it's just totally night and day. You know, I've heard of people paying less than $1,000 a year to insure Ferraris and Porsches and other high-end cars like McLarens or whatever. So it's a whole different world when it comes to these kinds of insurance policies. Also, once you have a bunch of assets, for example, house, jewelry, watches, cars, art, boats, these companies can offer what's called an umbrella policy for everything you own, including life insurance and all of that stuff, right? So once you roll all of this stuff into one giant umbrella policy, it becomes much, much cheaper. And it's not like insuring 5 daily driver pickup trucks or whatever. It's much, much more efficient in terms of the risk pool that you're going into and the actual premiums that you're going to pay. Okay, what about maintenance costs? Again, the thing to avoid is treating a high-end car like a daily driver car. So you're not going to stack 20,000 miles in a single year onto a high-end car. So the less miles you put on, the less maintenance it's going to take, the less tires, the less brakes, less oil changes, the less things are going to go wrong, right? Generally, these cars are very well warrantied for OEM and aftermarket because people don't drive these cars, so they have a very good warranty risk profile. Very few things actually break. This can obviously be abused. Like you could drive the shit out of a car and potentially cost a company a lot of money, but they'll just drop you if they get wind of that. So it's generally a pretty good idea to assume that you're not going to drive one of these cars very much, and therefore the maintenance costs are going to be low. Despite what you see on YouTube, most of the people who own these cars are very conservative drivers. They don't like attention. They don't go fast. Maybe they might speed on the highway a little bit, but they're not ripping around, doing donuts and doing top speed runs and all that sort of stuff. They're just older people that don't need to do that anymore. So obviously, if you don't abuse a car, or if you quote unquote under drive it or garage queen it, it's just not going to cost as much money. It's just going to sit there, and all you have to do is look at it and drive it and get oil changes. So in the end, the maintenance on these cars are not that much. Now, if you buy a used car that's been kind of clapped out and requires a bunch of work, that is just going to turn into a nightmare. But if you buy intelligently, again, you have to buy intelligently. It's not going to be a problem, especially if you live in a nice area with good roads and you have a garage and you don't drive it in the winter and keep it out of the salt. The cost is just very, very low. At the end of the day, these are not daily drivers for a lot of people. Some people drive them daily, and God bless them. But for most people, a car like this is not going to be a daily driver, right? You're going to have some kind of daily, and then you're going to drive the nice car a couple times a week, maybe even once a week or even less. But you can't use the same daily driver logic with toys. It's not going to break all the time, especially now. Most cars are very, very reliable. Especially the expensive ones, because they have a reputation to uphold these days, and only a few brands don't really try to keep a good reputation. Like I believe even Ferrari has an unlimited mileage warranty for the first 3 years. If you're insane enough to stack 100,000 miles onto a Ferrari in 3 years, I think they'll honor it. So the question is, should you buy an expensive car? This is, at some point, every car guy or car gal is gonna ask themselves this question. If you've been working for years, possibly 10 to 20 years, you have a good income, and you've always wanted a really, really expensive car or a nice car, you're gonna ask yourself, you're gonna sit down and start Googling, what's the smart thing to do here? Do I give up some money and get what I really want, or do I just never get this car and just do the smart thing and save my money and invest my money. And the thing is, you have to make your own decisions, right? You can't rely on others to make a yes or a no decision for you. You have to put on your big boy pants and actually decide for yourself if you want an expensive car. Obviously, for different people, this is going to, involve different psychologies. You could make $1 million a year, but have a real big hang up with money and just refuse to buy anything but the cheapest econo car. Or you might be the opposite and have a very high appetite for spending money on a car. It really just depends on your own personal desire, and more importantly, your own personal ability to manage your money in other areas, right? Like, there are people who will gladly give up vacations and meals out and even a bigger house for the car that they've always wanted. And there are people who think that's the stupidest idea that they've ever heard. So really, it just depends on what you get out of the car. Like, does this car actually make you want to work harder? Like, will getting into this thing and driving to work or going out for a weekend drive actually motivate you to work harder? Or is it just going to make you feel guilty that you bought this car with all this money? Like, different people are going to react different ways to that particular situation, right? Personally, cars motivate me to work harder, so I don't see them as a negative. It's more of a positive in my life. But there are people who, once they buy an expensive car, they just cannot live with themselves, and they they live in guilt until the day that they get rid of them. It's also very common with boats. Some people live for boats, like they live for the weekend and going out on the water and fishing or doing whatever. I'm not a boat guy, so I don't know the psychology there, but obviously some people also hate that they bought a boat and they can't wait to sell it. So this really just depends on knowing yourself and knowing where in the spectrum you fall. And that's where number 2 comes in. Like, what are your other goals in life? Do you actually have any? Some people don't. Some people do. Some people want to get married, have kids. Other people just don't. So it depends on what your other goals are, and you have to decide for yourself. One thing to keep in mind is you have to protect the downside. The worst thing you can do, no matter who you are, is buy overpriced junk with huge dealer markups. Never do that. That is just asking for trouble. Unless you are hell-bent on getting a particular car and you've wanted this thing ever since they announced it, at whatever auto show, and you saw the concept car and you felt like you would die if you didn't buy this thing, never do that. That's how people get upside down on loans. That's how people end up not being able to pay their bills, end up getting their cars repoed, or even worse, filing for bankruptcy. So never ever do that. That is one thing I can definitely tell you is a no. Number 4 is, if you learn to wrench on your own car, you can, over the long term, you can save a ton of money. Servicing a high-end car is obscenely expensive these days. Like, if you were to do oil changes every single year for a high-end car, I mean, it's going to cost you thousands upon thousands of dollars over a 10-year period. So if you can do basic stuff like oil changes, brake jobs, transmission fluid changes, differential fluid changes, just take your car to a regular tire shop instead of the dealership, all this stuff adds up into thousands of dollars, and you can actually, as long as you document everything with receipts, and maybe even take some video these days of yourself doing the work, it's not going to affect the value of the car as long as you do it correctly. So that's a general life skill, right? Like, even fixing stuff around the house. You can buy a house that needs work for a substantial discount if you can actually just fix a lot of the stuff yourself. So that's just smart in general. Number 5 is, are you confident in your ability to make money in the future? If you are not sure about this, that is a big, big problem. Generally, when you're buying something like a house or an expensive car, you have to know for sure that your career will be solid in the future. that means you have a very in-demand skill or some kind of graduate degree or some kind of professional, like you're a lawyer or a doctor. There's some kind of professional like moat around your career where not just anyone can just do your job. So if you don't have that and you're looking at a very expensive car, you might want to reconsider. I'm not going to say no. I'm not going to say that that's a definite no, but you might want to reconsider that. Also, do you have a safety net? Obviously, money is the ultimate safety net, but family, friends, etc. If you're young and you're kind of stretching to buy a car, do you have family that you can count on to possibly move back home without destroying your credit? Do you have friends that can help you in an emergency in case you have, if let's say you have car problems and you need a garage to work on your car. This is the kind of thing that a young person should probably think about, even when they're not buying a super high-end car, but just like I don't know, even a $50,000 car. If you're young and you don't know that you have a safety net to support that kind of purchase, you should reconsider. Number 7, generally this thing that you hear, if you need to ask, you probably can't afford it. Generally, that's pretty true. And it's not asking about the price, right? Price is just the price. Everyone needs to know the price. But if you need to ask, can I actually afford this? If you're like running the numbers over and over and over, if it's not a clear yes, you should definitely think really hard about it. However, number 8, if you're just a crazy gearhead and you have been into cars your entire life, you're going to do it anyways. Nothing is going to stop you, right? So you might as well do it right. So you have to take into consideration all of the stuff I talked about. Make sure that your career is right. Make sure you understand all of the financial options that go into purchasing an expensive car. Make sure you understand the insurance, the maintenance ramifications, and all of your and how it's going to affect all of your other goals in life. So, I mean, if you're young and a gearhead and you have a high income, you're definitely just going to buy the car. It's almost stupid to assume that you're not. So, with that in mind, I wish you the best of luck. Thanks for watching this video. If you have any questions, let me know. Otherwise, have a great one. All right, thanks. Bye.